Hi, tonight we analyze Q1 with my guest analyst, and I have Linda and Jesse, all from KCB Investment Bank, and of course Stella from SIB Bank, and we'll be letting you know what to do, what to expect, and the outlook. Gentlemen and ladies, welcome to the show.
Thank you.
Great. I'm curious, from your end, you sit at a place where you're able to have a view of how the entire market and even just the economy at large is doing. And I wanted to start from your general sentiments on what you've been observing. And I want to start with you, Linda, on the macro perspective. What have been your observation, especially through Q1 till now?
Thank you, Maina.
Yeah.
So quarter one of 2024 has been quite eventful. So we started the year in anticipation of a better year, of course, looking back at 2023, which was a tough year macroeconomically.
Yeah.
There was high inflation. Our shilling depreciated to some levels.
Quite levels, yes.
But then shock on us was that 2024 would be worse, actually, than what we had seen in 2023. And so in quarter one, mostly what we have seen is an improvement in the shilling. We have seen the Kenya shilling stabilize. There's a lot of negative sentiments on ability of the Kenyan government to pay the euro bond. But then we saw government treasury come in and settle that with the issuing of a new euro bond, and where some investors were able to redeem, and that put our sovereign risk at a better place.
Okay.
And so then this was reflected in our shilling, and that is when we saw the shilling strengthen with better sentiment. There was a bit of dollar liquidity crunch, and this improved slowly by slowly. Yeah.
Okay. That's a good one. And I'm sure, Jesse, out of all that, is there something else that you would want to just contribute on this macro effect that you've seen in Q1?
Yes, absolutely. Narrowing it down to the markets, we generally observed an overall bull run across listed stocks, particularly in the local Nairobi Securities Exchange. And this was driven majorly by performances in key sectors, majorly banking, a bit of manufacturing and insurance sectors.
Yeah. Okay. Stella, I'm sure you also have something else. I know they have said a lot, but any observations, especially Q1 through the macros?
Linda had mentioned about inflation.
Yes.
So we saw inflation decline in the first quarter of 2024. And the main attributing factor was the decline in fuel prices. And this was also made possible by the appreciation of the shilling against the dollar, because we import our fuel in dollars. So there was that positive aspect. We also saw a slight improvement in the first month of the year in the private sector business environment, and this is evidenced by the Purchasing Managers Index, which we saw an increase or a figure above 50, which means that the sector is expanding. Either way, the overall effect was a slight deterioration in business in the first quarter overall, but going forward, we expect to see more improvement with regards to the private sector, in that the input costs based on the fuel prices will have declined.
I'm always curious why we have price drops, things don't. Just for another day. Jesse, let me come to you. I saw you in some of the several bank full year results. I also saw you lead at some point. And we had an impressive record of the banking sector in general, really doing super well. But I wanted to ask you, looking through the year and what they released for the 2023, what are some of your key takeouts, if I may say that? And what do you see coming forward, especially in 2024?
Wonderful, Maina. Yes, we received numbers from banks, basically end of financial year 2023 numbers in March 2024, which indicated the true nature of how 2023 was, in terms of it being quite a difficult year across board. we saw a rise of approximately 54% year on year in non-performing loans across the banking sector. Despite that being a reflection of the tumultuous year 2023 we still saw the resilience in banks, particularly in terms of income, growing at about 11% year on year. We also saw total assets for the banking sector growing by about 20%. And when you look at specifically Tier 1 banks, we're looking at an year-on-year growth of about 17.7% in total assets. So just showing how banks are able to navigate through the difficult conditions. Linda and Stella have rightfully mentioned that 2023 was generally difficult across most sectors. In the NSE, particularly, we saw different companies announcing profit warnings, unable to report growth in profits. But then when you look at banks, you notice that those key metrics were still growing, and they are growing quite well. Consequently, also banks provisioned and covered for the non-performing loans quite adequately in 2023. And our forecast majorly is going into 2024. We're likely to see a lot of that unwinding, particularly in non-performing loans. And so we expect that a lot of the key sectors of the economy that were facing challenges, particularly in 2023, might have a bit of a reprieve in 2024, which might boost bank numbers. This is majorly driven from the fact that we are seeing interest rates currently circulating around their maximum levels, and therefore that might ease pressure on various key sectors of the economy, and therefore might lead to certain businesses beginning to perform. So our outlook is generally positive on banks.
Okay, that's a great one. So it means we still have good tidings coming up. So
definitely.
Great. I can't wait, because anyway, Q1 is over. We can't wait to see what they will do as well.
Yeah.
Let me come to you, Linda, and I think Jesse has really spoken enough on the banking side. I'd want us to look at the market here and the equities in general. And as we have had mixed portfolios here. Some people celebrating, others wondering what's happening. But I want to hear from your end. What has been your key observations through Q1 and maybe outlook towards it?
So we have seen a recovery in the indices performance, the NASI, NSE 25, NSE 20. And this has mostly been because locals have come in. Mm-hmm. Unlike before, where most trades were driven by foreigners, this year we have seen locals fund managers coming strong in the market. Yeah. Most buys were, of course, large cap counters, banks, of course, manufacturing, ABL, which despite a drop in the PAT, we have seen strong performance of the counter at the boss, showing there is positive sentiment, there is resilience of those individual companies in the different sectors. Given also that much is reported season for most counters, of course, with dividend announcement, then investors were coming in to try and take positions to take advantage of that also. And of course, we recognize and we applaud counters that despite a tumultuous 2023 and a drop in earnings or an environment of really uncertainty, some counters were still able to give dividends to shareholders, which is a welcome move. But then also going forward, most of the things that we expect to see affecting these counters will, of course, remain the general performance of the economy, how the economy performs in terms of inflation, growth, how the shilling performs. Know that we've seen that now tilt to what we had seen earlier on in February, where now the shilling has now been depreciating.
Okay. Let me come to a few other factors as well. And I think since we started Q1, we have seen the interest rates looking very good. I think the bond market has really surpassed expectations. We've seen the highest records ever here in the market. And I wanted to bring you in, Stella, and ask you, what's happening? Are we expecting to have a sustainable kind of increase like this?
On the bond market,
yes,
we saw significant performance and significant trading volumes in the first quarter, especially in the month of March, with the IFB, the 8.5 amortized bond. So the first, and the activity was mainly because of the interest rate or the coupon rate that this bond fetched. In that, for infrastructure bonds, the coupon is tax-free or the income is tax-free. So there was a lot of foreign participation, north of 50% of the overall performance, even in the secondary market, what we see at the NSE. The performance of the volumes traded was significantly high. So with regards to interest rates, we've started seeing a decline in the interest rates or the yields on this bond, as well as the yields on short-term papers, that is the treasury bill. So what is happening is that the government is very keen on pushing down the rates by rejecting overly priced bills. So this is where investors bid highly or at high rates, so the government rejects those particular bills and continuously focusing on external financing. So I'm sure you've seen a report on the expect money from the IMF. Mid-June or early July. We are also we expected the money by end of April from World Bank. I don't know what happened. They've not given us an update. So that was a huge sum of money which we expected to fill in or to come in for the budget deficit. So when the government has more external financing, they do not have pressure to get money from their local environment. So this definitely will enable them to push down rates or to reject rates that are really expensive from investors.
Interesting enough, I think still on news, Stella, there was sentiments that came out that the retail bond buyers have actually surpassed the corporates in a way. That means there's excitement from retail buyers.
Yes. The thinking is that retail investors also want a piece of the cake, of the high rates. So the rates had gone really up actually in the first quarter, but we really thought, and it's true, the rates have started to peak or have peaked, because now the yield curve on the short end and the tail of the curve is moderating. So the issue is with the BAILI, that is the medium-term papers, where rates are a bit obstinate, stubborn to say, but still increasing, not as high as before.
Still on Eastern, as I come to a close of this conversation, the shilling had interesting curves, if I may call them that. We saw, as Linda had put it, as at the close of last year, we were worried because where is the shilling going? There were many sentiments across. And then Q1, we see interesting drops. And now I don't know where we're headed because I think the curve is going up. What's happening? How can you explain this phenomenon of the shilling?
We still maintain, or I still maintain that the shilling is not being driven by fundamentals. Because fundamentals that are supposed to be moving the market or the foreign exchange market have not been that positive with regards to exports and imports, with regards to the outflows that are coming from the country in terms of debt repayment and even import fees, whatever we pay for our imports, because we keep saying that we are net importers. So the main factor that is supporting the movement of the shilling is sentiment. There's a lot of sentiment. Sentiment is related to feelings of investors and the people that are trading forex. So as of now, we have news or thinking that the Federal Reserve will not cut rates anytime soon. Because as the chair said, inflation in the economy is still stubborn, and it will take longer to anchor it or to bring it down to the target that they required to be. So with that, investors have switched or have shifted their sentiment with regards to the emerging markets that Kenya is part of. So we are yet to see significant outflows like before, but mainly it's sentiment that is moving the shilling. I like to call it behavioral economics because it's based on feelings and information and rumors of what people market.
Okay.
Yeah.
My goodness, I don't know what sentiments you have on that. Jesse, I'm coming to you. But even as you give sentiments on those areas that we have just touched on with Stella, I'd also want to hear your outlook, especially when you look through the market. Q2 is here and moving forward. Please go ahead.
I think so. Basically, we had issued an earlier recommendation to invest that keep invested, and I think the gospel hasn't changed because when you look at what has happened in Q1 alone, investors who took advantage of that piece of information would have benefited across board. When you look at the banking sector, general growth in share price. When you look at agricultural sector, stocks like Williamson Tea Kenya being the best performing in that area. Look at insurance, Liberty Group being the best performing. Look at manufacturing, EABL doing quite well. And so the encouragement still continues that being invested is still the best preferable option, even going forward. One key thing that to take note of is, time flies. The bad news. But the good news is you are the pilot, miner. So going forward into Q2, it would definitely be advantageous for any investor to take advantage of positions, particularly in the equity market. We're seeing quite a rally across board, and what we believe is that this rally might continue into Q2, particularly and even into the latter part of the year. Why? Because more opportunities are coming in. We are having a large number of discounted stocks which are trading at quite discounted values, despite being fundamentally sound, and we still see opportunities in that market. Equally, in the fixed income market, there's still a lot of opportunities still. Despite the fact that rates are at elevated levels, it still presents opportunity for us. And given sentiment coming in from the US, as Stella mentioned, we still gives opportunity for investors here locally to take advantage of the high rates while they still remain elevated.
Quite optimistic there. Linda, I want to come to you. I want to hear your outlook, and I don't know whether you have some best bets. Anyway, what's your advice to investors as well?
Okay, for me, I think what still stands out is as an investor, as a business person, as a Kenyan, I think that like 4 issues which mainly affect how we think, what our sentiment is. One is the shilling. 2 is where is our inflation rate. 3 is what is the outlook on economic growth. 4 is fuel.
Definitely.
Currently is a big thing. So to add to what Stella had said on the shilling, I think if you listen to what the CBK governor said after the last monetary policy committee meeting, CBK also expressed their concern that they too are watching how the shilling would pan out. But they also agreed that what was driving the shilling was not really fundamentals. It was mainly sentiment. Because then, if you are CBK today, the shilling is at 150. You are a country that borrows heavily in US dollars, so that means your debt is higher.
It's high,
and you're paying low on that debt. And CBK actually said when the shilling had depreciated to 160 levels, debt had gone up to over 1 trillion.
Wow!
So that means it was really bad.
It was really bad,
But then right now, the shilling has appreciated a bit. So that means our debt levels are a bit lower and we're paying lower in terms of interest rates. But then you do not want the shilling to also appreciate too much such that it affects other things, because then it makes your exports unattractive. It makes there are some taxes that are reported in terms of Kenya shilling where you have to convert. So it means then you have to report lower taxes. So then CBK that time alluded to the fact that they would too be watching how the shilling pans out, and they would be giving advice and also coming in to, I would say, advice on when they feel it's fundamentally driven, or it's sentiment driven, or it's emotionally driven, so that then investors would be aware. So if we look at inflation, I think the inflation number for April is here, 5%, which is really good. because then finally we are at CBK target, which is usually below 5%.
Okay.
But then this now still looks a bit, it's still, I think, or I feel that we will see some sticky figures around 5 point something, because then with these rains, we are not sure how the agricultural produce will turn out. And then there's now the burning issue of fuel.
Oh, yeah.
Where in the global markets, oil prices have been rising. And this has been driven by, of course, the Israel-Palestine war. That seemed like just a small conflict, but is now turning out to be quite escalating.
Yeah.
And of course, the Russia war still, the Russia-Ukraine war.
Yeah.
We are now used to that. And then there has been the OPEC committee met last month, and they agreed to voluntary supply cuts, almost 2.2 million barrels per day.
Okay.
So then that will affect oil supply.
Yeah.
So then the global outlook on oil is not really positive.
Oh.
So if you double that with our depreciating shilling, then that means this year, while the sentiment at the beginning of the year was really positive, there we might see a bit of uncertainty there.
Okay.
But of course, we remain positive, and I would say for investment, you can't really skin.
Like Jesse, stay invested, eh?
So for me, I would say investors should be on the look, provided you're invested in fundamentally sound companies. Look at what management is saying, read CEO surveys, what are CEOs, what's the outlook of CEOs. I think those are the things that investors should look at. But in our local market, banks, manufacturing still remain good sectors here.
Okay. I want to end this session with just one quick word from each of you. From a retailer who told me, if you meet those analysts, please ask them this question. I have my 200K, where do I throw the man? I don't put you on the spot. Everybody will have their answer. Just let me start with you. What did you tell the person?
Well, first of all, it's good that the person is thinking about investing. Let's begin there. And I think congratulations to the person. That's the first step to being financially sound individually. But I think the counters in the NSE provide you with a wide range of opportunities to invest in. Just for information purposes sake, the minimum you can buy is 100 shares.
Absolutely.
Yes. So, given, I wish I could meet him personally, I would give recommendation. Buy 100 shares of any share if you'll be able to.
So for you're saying, get some equities.
Get some equity.
Okay.
Get something with stake or which.
Okay. Stella, what do you think?
And tell the person to put the money on at the first starting.
Okay.
The income is tax-free.
Yes.
It's assured. The government won't default anything soon. Share.
It's okay. I put you on the spot. Linda, what do you need to the person?
Just like Stella, for me, I support fixed income.
Yes.
A treasury bill.
Yeah.
Probably a treasury bond, because the rates that we have here, probably in the next 2 years, in history. Okay. So, anyway, the time. Yeah.
Jesse, you're the man who takes risks, eh?
I rise and die with the market.
Okay, there you have it. Amazing conversation with Linda Kirai, Jesse Ludenyo, all from KCB Investment Bank, and Stella Soke from Senior Associate Research at Standard Investment Bank. Thank you so much for your time. And I leave you now with just the numbers and enjoy your liberty.